So I was wondering the other day, what should I advise my kids when they want to start investing their money? Excluding side hustles and starting a business, I was really stuck on the main difference between gold, the S&P 500, and buying single-family homes. I chose these three because I wanted to focus on something that is passive, long-term, and reasonably safe. Let's keep it simple. What would you do if you had $10,000 now and wanted to make the most of it passively 20 years into the future? Comment below before watching this, what would you do? And then let's see in the end who nailed it. Before we reveal which of the three is the best investment strategy, smash that like and subscribe button. It helps tremendously. What we're gonna do is look at the performance and why people invest in these three categories of gold, the S&P 500, and single-family houses over a 20-year period from the year 2000 to the end of 2022. It's very shocking what ends up coming out on top. Let's get into gold first. Gold is a precious metal that has been cherished by humans for thousands of years. Gold has been a store of value and a symbol of wealth since ancient civilizations. Its rarability, durability, and beauty made it the perfect form of currency. Fast forwarding to modern day, it exploded in popularity as the international monetary system from the 1870s to the early 1920s, from the 1920s to 1932, and back from 1944 up to 1971. It didn't end up skyrocketing in value though until the early 1970s when the Bretton Woods system was abandoned and gold was removed as the standard. It had a value of approximately $100 per troy ounce and within 40 years had exploded to $2,000 per troy ounce. That's almost a return on investment of 1,900% and yearly 7.78%. Countries stockpile gold up like pirates in good old days. But why? People and countries know it serves as a trusted asset that has stood the test of time, and thus it's an insurance policy against an economic crash. If the dollars of every country just ceased to exist, we could trade in weight of gold like in 550 BC when King Croesus of Lydia had it made into coins to circulate as currency. So we know why people have gold. Do you know who the biggest players are? Here's the top 5 countries holding gold right now. So USA comes in first with 8,133 tons, which is worth approximately $573 billion. Second is Germany with 3,354 tons, which is worth approximately $236.6 billion. Coming in third is Italy with 2,451 tons of gold, which is approximately $172.7 billion worth. And coming in fourth is France with 2,436 tons of gold, which is worth approximately $171.6 billion. And fifth is Russia with 2,326 tons, which is worth approximately $163.9 billion. So if we fast forward to today, gold remains an essential part of many investment portfolios, but why? Primarily, there are 3 reasons. The first is a hedge against inflation. As the cost of living goes up, the value of money goes down. However, gold often maintains its value, even appreciating during inflationary times. Second is as a safe haven. Gold is often considered a safe haven during economic downturns. When stock markets are volatile, gold can offer stability. Third is diversification. Adding gold to your portfolio can help spread risk as it often moves inversely to stock markets. Now, this isn't to say that gold is a risk-free investment. It can be quite volatile and doesn't offer dividend payments like stocks or rental income like real estate. However, its long-term trend has been upwards, making it a favorite for long-term investment strategies. So how can gold fit into your portfolio? It's all about balance. Financial advisors often recommend holding a small percentage of your portfolio in gold, anywhere from 5% to 20% depending on your risk tolerance and investment goals. Today, investing in gold just isn't about buying gold bars or coins. You can invest in gold ETFs, gold mining stocks, or even digital gold. So in the end, gold in January of 2000 was sitting at $510, and in January of 2020, it sat at $1,859. This puts it as a gain of 264% and an annual ROI of 6.68%. Now, many investors and bankers will tell you at conventional banks that that's a good investment. On to the S&P 500. The S&P 500, or Standard & Poor's 500, is a stock market index that measures the performance of 500 large companies listed on stock exchanges in the United States. It was introduced by the financial services company Standard & Poor's, now part of the S&P Global, in 1957. Its purpose was to provide a benchmark for the overall performance of the U.S. stock market or for specific sectors of the market, and to provide investors with a more accurate picture of market conditions. Here's a brief history of the S&P 500. In 1957, it had its inception. The S&P 500 was launched on March 4th, 1957. It replaced the S&P 90, a previous index that tracked the performance of 90 companies. In 1975, the electronic circulation. In 1975, there was the electronic calculation. The index started being calculated electronically in 1975, improving the accuracy and speed of calculations. 1980s to the 90s, the bull market came. During the 1980s and 90s, the S&P 500 experienced a prolonged bull market due to robust economic growth and technological innovations. In the 2000s, dot-com bubble. The index reached a peak in 2000 during the dot-com bubble when internet-based companies experienced a rapid rise in their stock prices. However, this bubble eventually burst, leading to a sharp decline in the index. In 2008, we had the financial crisis. The S&P 500 dropped significantly during the financial crisis of 2008 due to the collapse of large financial institutions and the bursting of the housing bubble. In the 2010s, we had recovery and growth. The index recovered after the financial crisis and experienced steady growth during the 2010s, driven by the performance of technology companies. In 2020, of course, we had COVID-19 pandemic. The S&P 500 experienced a sharp drop in early 2020 due to the global economic disruption. The S&P 500 experienced a sharp drop in early 2020 due to the global pandemic disruption caused by the COVID-19 pandemic. However, it recovered rapidly and reached new highs by the end of the year. In terms of why people invest in stocks, there are several reasons, and these reasons haven't changed much over the years. The first is wealth accumulation. Investing in stocks is a way to grow wealth over the long term. Despite periods of volatility and market downturns, the stock market has historically trended upward over the long term. For instance, the S&P 500 has averaged annual returns of approximately 10% since its inception. Inflation protection. Stocks can provide a hedge against inflation. As prices rise, companies may increase their prices, which can lead to higher profits and potentially higher stock prices. The third is dividends. Some companies distribute a portion of their earnings to shareholders in the form of dividends. This can provide a steady income stream in addition to any capital gains from the stock price increasing. Ownership and voting rights. Owning stocks means owning a part of the company. Shareholders often get voting rights on key company decisions and matters such as electing the board of directors. Next is diversification. Investing in a variety of stocks can help diversify an investment portfolio, which can help manage your risk. These reasons have been valid both in the past and today. The main difference now is that access to the stock market has become much easier due to advancement in technology. Today, individuals can buy and sell stocks on their own using online brokerage accounts. This has democratized the stock market and made it accessible to more people. So what's the return? In January 2000, it was priced at $2,505. And in January of 2020, it was priced at $3,793. This would give you a return on investment of 51.42% and an annualized ROI of 2.10%. This is really shocking because so many investment advisors and general business people suggest just throw your money into the S&P. It averages 15%. But from this time frame, that is bull. Yes, if you caught the '08 crash and invested in February of 2009 and caught it at 1,000 and sold in January 2020, it would be a 12% ROI. But we're not talking about taking advantage of major investment opportunities. We need the steady eddy. There are a lot of new ETFs out there, such as VOO, that have been putting out 11% plus annualized returns since their inception date of 2010, but I'm analyzing a longer time frame here. And by the way, if you want me to cover index funds, please let me know in the comments below saying, Business Behemoth, analyze some index funds for me so I don't have to. All right, last on the list is the single family homes investment. So there really is not much history about houses that I can't tell you where you wouldn't already know, so I'll just cut to the chase. In the year 2000, according to Statista.com, the price per square foot on average was $70.43. In 2020, it was at $122.12. If you look at a 2,000 square foot house, that would take you from $140,860 to $244,240, which is almost doubling your money. So where does that leave us? Let's tally all three up and take a look at the winner. So gold came in at 264% total return on investment, an annualized ROI of 6.68%. The S&P came in at 51.42% total, an annualized of 2.10%. And one of the most popular and well-pushed investment ideas of buying single-family homes and managing or hiring someone to manage them with a lot of capital required and usually debt just to invest in came at 73.39% total return on investment, an annualized ROI of 2.79%. The winner is gold. I myself was quite shocked and surprised gold was the winner, but it's just mind-boggling that gold continues to stand the test of time as a secure and safe investment. I look forward to seeing what everyone else guessed in the comments, and of course, don't forget to like and subscribe. I'll see you in the next video.